And I suppose let's get going. The rest will join if they join. Okay, so good morning, good afternoon, good evening, wherever you are. Thanks very much for joining us for our quarterly updates. The first couple of months of the fund have been in reasonably challenging conditions. Just to go through the agenda quickly, I'm going to introduce Michael Swenson, the CEO and co-founder of M31 Capital. We'll talk briefly about the objective of the fund and overview of the fund, our review of performance over the past few months. We'll talk a little bit about the market as well as the outlook for Bitcoin. So over to you, Mike.
Sorry, over to me.
Over to you.
Yeah, sorry about that. I got a phone
No
turned
worries.
it over to me. Yeah, hey, welcome everyone. Thanks for joining, Mark. Thanks for me. I just wanted to kind of pop in and introduce myself and give a little background about M31 Capital and myself, and then kind of turn it back over to Mark and let him spend the majority of the call kind of walking through, the webinar and the fund and the strategy and how it's been performing and how to get involved because that's the more interesting stuff, I'm sure. So just quickly, Michael Swenson, COO and co-founder at M31 Capital. We launched back in January 2020, so just about 6 years ago. I come from 2 decades plus of Wall Street experience working in traditional finance at, Bridgewater Associates, Goldman Sachs, AllianceBernstein, a bunch of big banks and hedge funds. And my career has kind of been centered and focused on building best-in-class operations those with the appropriate risk security oversight compliance programs allow these big institutions to go after whatever opportunities they want to go after, but do so in a very compliant way and also a very efficient way. And so it's kind of how I developed a certain skill set over the years. And in 2019, got started getting very interested in advanced technologies like blockchain and AI and some other things. And what I found is about 6 months into that journey, I realized I was in the wrong space and wanted to do something full time. And at that time, I got connected to Nathan, who you can see on the slide, and Nathan, kind of right out of Columbia and Harvard, got into blockchain technologies very early on, very early adopter. Got his first Bitcoin back in 2011, and has never turned back. And so it was this really interesting mix of Nathan's very technical understanding of the space and investments in the space, and then my traditional finance background kind of coming together to create this institutional grade platform and fund for investors around the world to get access to a variety of different strategies with different risk profiles, but doing so in a very risk compliant, traditional way that investors could trust and feel comfortable with. And so that's kind of where we started in 2020. Like I said, about 6 years ago, we have a bunch of different funds at this point, liquid, only private equity. We kind of invest across the technology spectrum. But we're kind of at its foundation, a research-driven investment firm, kind of focused on technology paradigm shifts and looking for those and identifying them early, and then figuring out the best ways to kind of invest in them. And so Mark's going to walk you through, his Bitcoin compounding strategy. That he's kind of come up with this novel approach of how to do this and why it's a beneficial approach versus just a buy and hold. But that's the type of things we're looking for in the space, and so we're lucky to have Mark join us. I guess it was about, I don't know, 6 months, a year ago, full
Mm,
time, but we've known Mark dating back to, early 2020
mm.
frames. We've known each other for quite some time, and now he's with us, full time running the strategy and doing a great job. So again, great to meet everyone. I'll be around after the call. If you have any questions or want to speak to me, Mark can also connect you directly with me one-on-one.
Thanks, Michael. Okay. So I've generally met majority of people that I've invited to the call. So just briefly, the genesis of this strategy came from my time when I was at Goldman's dealing with family offices, and often on the private wealth side, investors would have large holdings they either didn't want to exit or couldn't exit for a variety of reasons. And we would come up with strategies on, either how to collar and rehypothecate or lend against it for diversification benefits, use it as collateral, but also how to generate yield on that. And then that translated further down the line into running these strategies on equities that we wanted to hold for the long term and other volatile risk assets, particularly platinum in the late, call it 2007, 8 into 2009, oil, etc. And Bitcoin kind of, in the beginning, in its formative days, the volatility was just way too high, and also the liquidity in the market wasn't there. But since call it 2022, 23, we've seen exchanges that provide really really tight spreads, good funding rates, and the ability to their inverse options, so you can actually settle in Bitcoin using Bitcoin as collateral. So the investment thesis is simple. It's that you want to hold Bitcoin for the long term and you don't want to trade the Bitcoin. You believe the price is going to be up and to the right. We don't have any real predictions, but we believe demand will outstrip supply by a factor of at least three over the next 5 years. The challenge is traditional methods of generating yield don't really work for Bitcoin because it's not continuous like you'd have with fixed income, etc. It's discontinuous and you have massive shifts. Bitcoin tends to do nothing for a while or trade sideways, and then it has really sharp rallies or corrections. And given that the strategy uses in its second leg a slight amount of leverage, you have to be quite careful that you don't ever put the Bitcoin at liquidation risk. So the first rule is, don't lose the Bitcoin, and the second rule is obviously don't forget the first rule. And we managed that very successfully with, out of the money puts generally 20% above any estimated liquidation price. So there's no chance, you'll have an unrealized mark to market volatility, but that volatility is opportunity. It's not risk. There's no risk of ever actually getting liquidated. So, as I said, you want to just to give you a quick update on the fund in terms of its strategy, you want to hold the Bitcoin for the long term. We want to generate yield. We want to generate between 2 to 3% a month in additional gross yield. We can adjust the yield slightly up or down if we need to in terms of the vol and the outlook for the market. And we generally start the trade with selling short dated puts. We then enter a slightly leveraged position and sell covered calls against it. So what it results in is a convex strategy where you're sort of mitigating the downside of the market. The long puts open up as a parachute when the market goes through a certain threshold, generally between 25 to 35% down. And you're never selling calls against the actual Bitcoin. So it's uncovered. So, if Bitcoin gaps up 50%, let's say, you'll get the full price appreciation of the Bitcoin. However, your yield will still only be 1 or 2% because the futures will get capped out by the sold calls. I'm happy to talk through the strategy in more detail if anyone has any further questions. You can see over the past, call it 5 months, even though the market has been generally one-way traffic, we've managed to generate another 14% in terms of gross yield. The net yield will obviously be lower because there's a transfer of value from the Bitcoin to the futures as your futures position comes down, but that is an unrealized loss. And if you don't believe Bitcoin's going back to our initial all-in dial-in price, which is about 90 odd thousand, then the strategy isn't, that you don't have the same positive outlook over the longer term. But that value then gets unlocked, and that gross yield will then be, a factor much higher. The net yield will be even higher than the gross yield at the moment. I think that, to our credit, the market corrected when we started the strategy. It had just come off 125. We entered the market at around 107,000. It's the last time it saw that in the beginning of November around Guy Fawkes Day. And since then, it kind of capitulated quite badly into January. But February was a real capitulation month where we saw, unfortunately, we saw a massive amount of liquidations. I think we saw around about 5 billion in cryptocurrency liquidations. And Bitcoin at its worst day, I think one of the largest daily drops in its history. It was a 14% decline, I think, on the 5th of February. We can talk about the macro and the fact that there was the Walsh Fed nomination, which was seen as hawkish, and people were concerned about liquidity. But I believe Bitcoin is generally the canary in the coal mine and tends to sniff out when inflation expectations are going to kick up. And now we saw with the escalation of this Iran conflict, the expectation that oil was going to spike, and therefore I think that we were expecting long duration assets like Bitcoin. They got hit pretty hard. But it's not a statistical outlier. This is what's important. This is kind of it's not a bug. It's a feature of trading Bitcoin, and that feature is how we generate yield because the implied vol stays much higher than the actual realized vol. This is kind of the chart that I believe and we've been tracking. And I think it's kind of played out. We don't base our trade on the chart, but we just kind of take a view as to at this point, should we be getting slightly more aggressive or should we be dialing back some of the exposure? And the reality is, things are looking a lot better. It feels a bit better. However, and Polymarkets is calling for an end to this conflict by May. However, if it continues further on June, July, then you will see, inflation start to spike really badly out of control. Rates will go up, global economy will pull back quite sharply, and then I think all risk assets will have a capitulation event into the second half of 2026. However, I do believe that this will set us up for, once again, getting back to our hopefully all-time highs towards the end of the year, beginning of next year. So I see a strong recovery in 27, potentially a bit of a blow off and a bubble in 28, and then I'm kind of thinking with the rate cycle is 2029 could be the next real correction. So I just want to focus briefly on the macro in terms of Bitcoin's 4-year cycle that everyone's been talking about and what our outlook is. So if we take a look at the macro, the real top-down macro, and say, well, what is the big wave of innovation? And I do believe it's everything moving onto the chain. I think crypto assets have been at the forefront of that. And then when you're combining the likes of AI and IoT, etc., I think we've seen that Bitcoin has definitely matured in its price behavior. So it's kind of it's gone through that initial acceptance. It's reached the tipping point in terms of adoption. It's become a completely legitimized asset class. It was the fastest asset to $1 trillion in terms of took 12 years faster than any other asset in history. So it has rightfully claimed its place as a mainstream investable asset and is now, pretty much accepted by all major institutions. It was spoken, there was pushback by the big asset allocators and fund managers, the likes of BlackRock and JP Morgan, etc. But that has been completely reversed. And I think the biggest change was the regulatory framework, which became a lot clearer. So it's now being completely integrated into traditional financial products and can be used as collateral, which is where we'll see the next level of innovation come from. So in terms of the 4-year cycle, it's definitely maturing. It's no longer following that 4-year pattern. And why we know that is the cycle, we're seeing new all-time lows in volatility much sooner than the previous cycles. So, what that tells us is that there's now more of a spread or a duration of buyers and sellers. There's no longer just hedges and speculators. You now have, digital asset treasury companies or DATCOs, you now have sovereign wealth funds, you now have other institutions, you have hedge funds. So you have a much longer asset and liability matching. And because of that, people, it doesn't just have this very thin liquidity. It's still reasonably liquid, but it's also a continuous 24-hour market. But I do think that we're seeing a maturation of the space, and that's giving a bit more of a dampening of volatility, which also comes from being, an increase in size and liquidity across more multiple exchanges. But it's definitely an indication of how it's grown in that it's twice the size now. It's twice the size now in terms of its market cap than it was at its cycle peak in 2021 and 10 times larger than it was in 2017. And that's not that long ago, sort of 8, 9 years ago, and 200 times larger than its 2013 peak. So it resembles a mature asset and is behaving as such. And one of the main reasons, as I've said, is a changing demand dynamic where you have a lot of exchange traded products and a lot of public companies now, because BlackRock's saying, well, you can use this as collateral, it can sit on your balance sheet. So the likes, it's not just the Teslas and so on, but there's a lot of excess lazy cash sitting on those balance sheets that can now be allocated. And you're seeing, I believe, call it 1.5 to 2 million Bitcoin have been pulled out of circulation, and I think that trend is going to continue. In terms of the profit to volatility ratio, this is just something that we keep our eye on, which says, the typical 4-year cycle is no longer applicable because in the initial days, the most of the supply was held by a small amount of individuals, let's say in self-custody on a limited number of exchanges, and that's completely changed. The new buyers are fundamentally, they're changing the structure of the Bitcoin market. I think that there'll be volatility to the up and downside. I think it will persist. I don't think that's done. But I do believe that this boom bust cycle will be a lot more muted. And that's why this fund and this trade really has, it's not a very limited shelf life, but it's kind of got a very sweet spot for the next 3 to 5 years. And then I think you'll get a slight compression of volatility, which means it'll be more difficult to generate the 2 to 3% yield on a monthly basis. This was an interesting chart to me, courtesy of Fidelity. This was a prediction model. So this is what it predicted in terms of the take up and the growth. So the supply side of the story to me is starting to look increasingly tight. You've got call it 20 odd million Bitcoin. And if you take a look at how many have been permanently lost and how many are locked up in ETFs, the reality is you've got under 15 million Bitcoin that can actually be traded. And now we have issuance of only around 160 odd thousand coins, which is way lower than gold's supply growth. So I think that, if you look at the demand side, the initial ETF institutional demand, it didn't exist in this original Fidelity chart. And BlackRock's IBIT today alone holds close to 1 million Bitcoin. And I think Bitwise was projecting that ETFs will absorb almost 100% of all supply potentially going forward. So demand is structurally outpacing supply at these current prices. And here you can see how it's tracking really in terms of adoption, it's tracking above where supply is. So I'm very comfortable to say, thinking that demand is not just cyclical, this is a secular shift. It's an actual upward move of the demand curve, not a movement along the curve. Then you have, the main macro driver of people looking for, store of value and a hedge against inflation is we have this complete debasement of currencies. So across all measures, you have, global liquidity rising, M2 rising, etc. Everything's liquidity is rising. So in some ways, I don't want to say that Bitcoin is not getting traction or gold. It's more that the dollar is just unfortunately losing value. And this has been highlighted recently with the potential, threat to the petrodollar. I think the macro trade over the next 3 to 5 years, I would say, is short fiat and long scarce assets. And Bitcoin fits perfectly into that trade. And now just generating yield on top of that is a very, it's a great way to generate the additional performance and alpha. So that's pretty much the end of the discussion from my side. Um, I think the main takeaways to focus on is number one, we're not in the same market we were 10 years ago. The way you made money in the past is going to change how you make money going forward. I think we definitely have, a lot more maturation in the market, not just in terms of custody solutions. I mean, as Mike was saying early on, we invested in M31 and we were looking at lots of funds back in 2019, 2020. Custody solutions were very, very fragile. Counterparty risk was huge. It was very difficult to find people that understood both traditional finance in terms of risk and volatility and, how to manage money, as well as people who understood the blockchain and what the actual applications were going to be and how DeFi really worked. Now the market has matured quite a bit, and there's a lot more validity in terms of the participants and a lot more legitimization. You never had sovereign wealth funds, call it, 6, 7 years ago, 10 years ago. You never had, a lot of companies purchasing Bitcoin on their balance sheets, excluding the micro strategies. So I think it's been, largely overlooked by major institutions. It was seen as very high risk. My next installment, in terms of the newsletter coming out early May, will focus on more of a institutional portfolio management view as to why you have to hold Bitcoin. Like why adding 2 to 3% of your portfolio in the likes of Bitcoin not only lowers the risk, increases diversification, but increases your alpha, like increases your Sharpe ratio by a factor of like 15 to 20%. The question is therefore why institutional investors not holding Bitcoin, not why they should hold it anymore. And the US has led the way in terms of the shift. It's been a lot more supportive environment for institutional investors. And although I always say you need to look through the cycle. So like there's all this noise about what's happening in the world and conflict and there's potential like, worries around fertilizer and inflation and so on. But if you take a look at that noise leads to perception and price and it's real, but then look at the underlying fundamentals. And this is what we saw in 2021, 22. A lot of the big institutions were pushing back against crypto, but they were laying the foundation, they were laying the plumbing for adoption of it. So while they were telling you how, don't invest in this, they were actually kind of already putting down foundations into the space. And over the last 2 to 3 months, these are headlines. I will send you a copy of the deck. You can click on any of these. These are the headlines that we've been seeing over the last 2 to 3 months. And the majority, excluding the macro, which we have no control over, are very positive in terms of, where we're seeing adoption moving to. So that's pretty much the end of it from my side. But just a quick preview as to what's coming. We'll talk about in the next newsletter and the next market update is, you know, why institutional investors not holding Bitcoin in terms of, how many years of data we have, in terms of how it's the best performing asset class over 10 years, how it improves your Sharpe ratio, and the fact that these investment theses, these 5 pillars, and this is all Fidelity's work, I'm just borrowing, in terms of the scarcity of it, in terms of the hedge against inflation long term, in terms of a portfolio diversifier, and the fact that it's volatility is very important, that the volatility is skewed to the upside. And that's something that many people don't really understand when they take a look at the space over the longer term. So that's pretty much the end of it. Thanks very much for your time. If there's any questions or anything that any people can raise their hands, and we're happy to have a conversation. Otherwise, you can get hold of me or Mike, and we can continue chatting then. If anyone needs to, I think you have to need to raise your hand. I think it is if you need to talk. I'm happy to unmute anyone if they want to have a quick question. Mike, I don't know if you have anything else to add to that.
Yeah, nothing to add. I think it was a good overview. Again, I think the timing wise is probably the thing to continuously to push on. And you kind of went through that a little bit of what we've been through the past 6 months and kind of where we're going. Um, it's easy for people to wait until markets
Mm,
get more directional and start to rebound. You actually want to be before then. So, again, when the exact moment's going to be, I don't know. I mean, we're more long-term bullish, obviously Bitcoin and on the space and the strategy, but I would say like now's a really great time to get positioned while the market's still kind of at a discount. And, obviously your job as a portfolio manager and our job is to kind of keep an eye on the macro things and other things that are going on. You got to get positioned and get exposure, and now's a great time to do it. So, like again, that's probably the key point. But yeah, and anyone that wants to reach out to you or me after the call, like you said, you're going to be circulating the video, the data room. There's information and case studies. I'm sure you can walk them through more,
mm.
Mark. And yeah, it was a great overview. There for inviting me again, and hope to hear everyone on the call.
Thanks, Mark. I appreciate you joining. Enjoy the rest of your evening there out there in Scottsdale. We'll enjoy the morning here and keep the economy ticking over in Brisbane. You do the same there, and we'll catch up soon.